Hello, everyone. Today we will cover Chapter 1, Introduction to Managerial Accounting. The role of managerial accounting in organizations is to provide useful information to internal managers. This is an important distinction from managerial accounting to financial accounting. So just keep that in mind as we go through this slide and the examples. If you compare the two, financial accounting and managerial accounting, the biggest difference is financial accounting is used by external parties, while managerial accounting is used by internal parties. The plus side to that is we don't have to follow GAAP. If you remember from financial accounting, part of our what made that class so hard was that we had to follow GAAP. In managerial accounting, we basically can do whatever we want. We can come up with various internal reports like for budgeting, for performance evaluations, cost reports, all kinds of things. Where in financial accounting, everything that we look at is objective, reliable, historical. There's really hard and fast rules. In managerial accounting, it's just the opposite. Everything's subjective. It's pretty relevant and it's future oriented, so it's important. Um, the level of detail and frequency, you can read all this stuff. I don't want to read these slides to you because you can read them yourself. I just want to try to explain some of the bigger concepts. The level of detail for financial accounting, we look at the company as a whole. So we take all of that information, we enter all that data, and we come up with these really large reports that pull everything together from all areas. In managerial accounting, we may be just doing a report on a single product or a single customer, things like that. So, types of organizations. Manufacturing firms versus merchandising companies versus service companies. And this is kind of a review because we went over this in 211 as well. In manufacturing firms, they're purchasing raw materials and they're making a product to sell to customers. In merchandising product or companies, they're taking those goods that the manufacturers produce and they're selling them to the general public, or they're selling them as a wholesaler. In service companies, of course, we just provide a service to customers or clients. In this chapter, we start talking about some terminology that we use to categorize or sort costs into different buckets. And I actually really hate that term buckets, but it works in this instance. We start looking at direct or indirect costs, variable or fixed costs, manufacturing or non-manufacturing costs, product or period costs, and we look at whether costs are relevant or irrelevant. It's really important that you understand each one of these things because we'll use this information that you learn in this chapter throughout the entire textbook. So let's go through them. Direct costs versus indirect costs. So it's just really as simple as, can that cost be easily and conveniently traced to one single unit of product? Now we know it went in that product. Do we actually know how much exactly went in that product? And do we actually track that? Or do we just know that it went in that product, but we're not really sure exactly how much went in that? For instance, for California Pizza Kitchen, direct costs are the materials and direct labor that can be traced to each individual pizza. But indirect costs, that it still costs this to make the product, but we can't trace it to an individual pizza. Things like the depreciation on the ovens that we bake the pizza in, the utilities for the building where we either rent or own, advertising, supervision, those types of things are indirect costs, but they still are part of the product costs. So that's direct versus indirect. Variable versus fixed costs. This is an important concept. You will use this over and over again all semester. So variable costs behave in a certain manner. They change in total in direct proportion to changes in activity level. That means that if we serve one customer, our variable cost goes up by 1 unit. If we serve 2, it goes up by 2 units. If we serve 3, and so on and so forth. So the line looks like this for the costs. That's in total. The per unit variable cost remains the same no matter how many customers we serve. If we serve 0 or 1,000, our per unit cost is the same within a relevant range. So we'll always qualify that with the concept that it has to be within a relevant range. Obviously, if we serve 1 million customers, things might change a bit. So remember, we're talking about relevant range. And this seems to be a really simple concept until you try to apply it. So variable costs change in total in direct proportion. They have a linear behavior pattern, and they remain the same per unit. While fixed costs do not change in total, in other words, they're fixed, our rent stays the same whether we serve 1 customer or 100 customers. That's fixed, at least within that reasonable range of activity. Always keep that in mind. The average per unit fixed costs will go down the more customers we serve. If we serve only 1 customer, all of that rent is allocated to that 1 customer. But if we serve 1,000 customers, we can divide that fixed cost between 1,000 customers. So fixed costs do not change in total, but they change per unit. While variable costs change in total, but they don't change per unit. Exact opposite behaviors. Let's look at an example of that. So you can actually pull this up on in your textbook, and I'm going to just move this stuff over so you can see it. You can pull this problem up in your textbook, and I'm actually going to write this problem out, and I'll post the solution. I'll post what I write as well. So M1-7, which is mini exercise 1-7 in your textbook. Jackson Lamps manufactures and sells table lamps. We want to determine whether each of the following things is fixed or variable. So for number 1, lampshades, is that fixed or variable? If we produce 1 lampshade versus producing 10, does it change? Yes, it does change, so that's variable. The glue and screws used in manufacturing, is that fixed or variable? Well, it goes up. If we produce 1 more lamp, we use more glue and screws, so that's variable. 3, the CEO of the company's salary, fixed or variable? Well, probably the CEO's salary is not going to change if we produce 1 unit or 1,000 units within the relevant range. So we're going to call that fixed. Assemblers' wages. Well, if they have to assemble more, then we probably have to hire more people. So if we produce more units, we're going to have more assembler wages within a relevant range as usual. Sometimes we call those things step variables. The amount of the wages will remain the same up to a certain point, and then they'll take a little jump, and then they'll remain the same again for a while. So 5, rent for the factory. Rent for the factory would probably be fixed because presuming it doesn't change if we produce 1 more unit or sell 1 more unit. 6, plant supervisor's salary. Anytime you see the term salary, you can pretty much presume that it is a fixed cost because it doesn't matter how many units you manufacture and sell, the plant supervisor's salary remains the same. Depreciation on a delivery truck. Again, it doesn't matter how many units we manufacture or sell, the depreciation on the delivery truck remains the same, so it's fixed. Power used for welding equipment. Presuming we have to weld to produce or manufacture the lamps, then if we produce more or manufacture more, then we would use more power. So that's variable. And 9, sales commissions. Well, sales commissions by its definition is paid by the number of units that are sold. So if they sell more units, the sales commissions will increase. That makes that variable. I hope that kind of helps to review this. All right, let's go back to the slides. Now we'll talk about manufacturing versus non-manufacturing costs. Manufacturing costs include all the costs that are incurred to produce that physical product. And you'll hear this over and over all semester, and we end up using acronyms for it because we say it so much. Direct materials, DM. Direct labor, DL. Manufacturing overhead, MOH. These are the 3 manufacturing costs. DM, DL, MOH. It's really important that you remember this or refer back to it because we'll use it again throughout the semester. So the manufacturing or product costs are DM, DL, and MOH. Let's talk about each one of those. Direct materials. Those material inputs that we can physically and conveniently, that's important, conveniently, trace directly to the final product. For example, the glass windows installed on an automobile, the dough, sauce, cheese, and meat for a pizza. We know exactly how much went on that pizza. We know exactly how many windows went in that automobile. That's direct materials, DM. Direct labor. The cost of the labor that can be physically and conveniently, again, note that word, traced to the final product. Wages paid to the automobile assembly workers. We can trace that right to the product because they're working on the line. Wages paid to the employees on the pizza production line. Again, we can trace it directly to that product. So that's direct labor, DL. So there are 3, DM, DL, and MOH, direct materials, direct labor, and manufacturing overhead. Manufacturing overhead is everything else. If it's a manufacturing cost or a product cost, and we'll talk about product costs soon, then everything that's not direct materials or not direct labor is manufacturing overhead. It's kind of a catch-all for all those things that we can't trace directly to that product. For instance, the production equipment, the utilities, the property taxes, the depreciation on the factory building, the insurance on the factory building, the salaries for the supervisors, the janitors, the security guards, anything that has to do with making that product, but it's not direct materials and it's not direct labor. It is manufacturing overhead. So those 3, DM, DL, MOH, direct materials, direct labor, and manufacturing overhead. So what about, they talk about in the textbook, they talk about prime cost and conversion cost. So sometimes we add things together and call them something else. So direct materials is a prime cost. Direct labor is a prime cost, but it's also a conversion cost, and manufacturing overhead is a conversion cost. If you think about it like this, a conversion cost is where we take the direct materials and we use the labor and all the overhead to convert those direct materials into a final product. That's conversion cost. What about non-manufacturing costs? That's everything that doesn't have to do with manufacturing the product directly. Marketing or selling costs, those are that is a non-manufacturing cost, and so are general and administrative costs. So marketing and selling, all the costs to get the order and deliver the product. General and administrative, all the executive, organizational, and clerical costs, like the CEO of the organization. Not the manager or of the supervisor or the supervisor of the product line, but the CEO of the whole organization. These are called general and administrative costs. So now we've got manufacturing costs, which are DM, DL, and MOH, direct materials, direct labor, and manufacturing overhead. And then we have non-manufacturing costs, which are marketing or selling and the general and administrative costs. Then we have product versus period costs, and all of these are related. If it's a product cost, it's manufacturing cost. If it's a period cost, it's non-manufacturing costs. Product costs flow from the direct materials, the direct labor, and the manufacturing overhead, remember those three, into something called work in process inventory. That's an inventory on the balance sheet. We added direct materials, we added direct labor, and we added overhead, and we put it in this inventory because we're not done with it yet. We're still working on it. When we're finished working on it, we move it into finished goods inventory. When we sell it, we move it out of finished goods inventory into cost of goods sold. So the balance sheet holds the two inventory accounts, the work in process inventory and the finished goods inventory. Those are assets. When we sell it, it moves out of those assets into an expense account on the income statement called cost of goods sold, or COGS for short, COGS. So we don't directly expense this stuff as we use it. We hold it until we sell that product or piece of inventory, and then we expense it. Non-manufacturing costs or period costs are costs that we just expense right away. That's the selling, the general administrative, things like that. We expense those right away on the income statement. So product versus period. A product cost is the manufacturing cost, DM, DL, MOH. A period cost is all the non-manufacturing costs. Let's do some examples. So I have about 4 examples I want to go through here. You pull this up. The first one that I want to cover is M1-8. And I'll try to get this on here so you can actually see it. Bear with me. M1-8. So Top Shelf Company builds oak bookcases. We want to determine whether each of the following is a direct material, a DM, a direct labor, a DL, a manufacturing overhead, MOH, or a period cost. Now remember, DM, DL, and MOH are all product costs, so everything else would be period costs. Let's just go down the list. Number 1, depreciation on factory equipment. Well, it's obviously a product cost because it's the factory. But we probably can't trace it to an individual product, so we're going to call it MOH. Because it's not direct materials and it's not direct labor, so it must be manufacturing overhead. 2, Depreciation on delivery trucks. Well, the delivery trucks have to do with selling a product. So it's not a product cost, so it must be a period cost. Wood used to build a bookcase. Presumably, we can trace the amount of wood fairly easily that we use to build a bookcase. So that's direct materials. Production supervisor's salary. There's that salary thing again, but it also says production. So it has to do with the product. So we know it's either DM, DL, or MOH. It's not direct labor because they're a supervisor. They don't actually work on the product. And we can't trace the amount of labor to a specific product. So it's not DL, it's not DM, so it must be MOH. 5. Glue and screws used in the bookcase. Well, we could say this is a direct materials, but we're probably not measuring or weighing the amount of glue and the number of screws that we use in a bookcase. Those are not easily traced to the bookcase itself because they're small items. So it's not direct labor for sure. And we've determined it's not direct materials because it's too hard to trace. So it has to be MOH, manufacturing overhead. Wages of the persons who assemble the bookcase. Oh, now we know these people are working directly on the bookcase. So that's direct labor. It's a product cost and it's direct labor. 7. Cost to run an ad on a local radio station. Well, probably advertising, right? That's not a product cost, so that would be a period cost. 8. Rent for the factory. Oops, there's that term, factory, so we know it's a product cost. Well, it's not direct materials and it's not direct labor, so it must be MOH. 9. Sorry, I lost my place. CEO's salary. Well, it doesn't mention that the CEO has anything to do with direct supervision in the production area. They're CEO of the company, so it's not a product cost, so it must be a period cost. 10. Wages of the person who sands the wood after it's cut. Direct labor. We can trace it directly to that product. So do you see how we can start working through this stuff, I hope? Sorry, I'm asking questions and I know you can't answer me. Okay, let's move on to the next one. Let's take this stuff. It's the same information we just had, except we have numbers. So we're given all these numbers and we're asked to determine each of the following costs for top shelf. This is actually M1-9. Direct materials used. So we can look at this list and figure out which ones are direct materials. Well, depreciation, oops, wood used to build bookcases, 1,500. We know that's a direct material. Let's see if there's anything else that's a direct material. Glues and screws. Nope, it's not. And we could actually look back at our list of things that we did back here and determine what we categorized it at. But we'll do it again just for practice. So 1, direct materials is 1,500. There's only one of them. 2, direct labor. Well, let's look down our list. Direct labor, depreciation, production supervisor's salary. There's that word salary, so that's not direct. Wages of person who assembles the bookcases. That's direct, 2,500. So let's write that down. Add rent, CEO salary. Oh, wages of person who sands the wood after it's cut. That's another direct labor. So there were 2 of them, and that equals 4,100. 3, manufacturing overhead. So we go back through and pick out all the manufacturing overhead. Everything that has to do, that's a product cost, has to do with the factory, that's not direct materials and direct labor. So we'll go down the list. First one is depreciation, 1,800. That because it's depreciation on factory equipment. The depreciation on the delivery trucks has to do with sales. We've already used wood, that's DM. Production supervisor salary. There we go. That has to do with manufacturing or the product. So it's 2,800 because that was not direct materials or direct labor. And then the glue and screws, 250. And then the rent for the factory, 3,500. And that total equals 8,350. All right. Next one, 4, prime cost. Prime cost is equal to direct materials and direct labor. So direct materials we calculated to be 1,500 and direct labor we already calculated to be 4,100. So that totals 5,600. Okay, number 5. Let me move this up just a tad. Conversion cost. Conversion cost equals direct labor plus manufacturing overhead. And we calculated direct labor to be 4,100, and we calculated manufacturing overhead to be 8,350. So that totals, sorry, I forgot to add that one up. 41, 8,350, 12,450. Okay. Number 6, total manufacturing costs. That's DM plus DL plus MOH. And that is 1,500 plus 4,100 plus 8,350. And that totals 13,950. Okay. Total non-manufacturing costs, which are the period costs. We actually had 3 of those. We had the delivery trucks depreciation, which was 800. We had the cost to run an ad, which was 600. And we had the CEO's salary, which was 3,000. 4,400 total. Okay. So let's move on to the next one. E1-6. And on this one, I'm going to do this. We'll kind of mark it on here. I realize this is kind of small. Let me see if I can. Yeah, I can't make that any bigger. So I just did a snip of this so I could actually mark it as we went. So we're asked to categorize, use an X to categorize each of the following. So you can have more than one X for each item. So we have product cost, DM, DL, MOH. Then we have period cost, then we have variable, and then we have fixed. So let's look at the CFO's salary. Well, its CFO salary would not be a product cost. It would be a period cost. And since it's a salary, it's going to be fixed. Okay. Factory utilities. So we know it's a product cost. It's not DMs, not DL, so it must be MOH. It's not a period cost because it's a product cost. So it's either a period or a product, and then it's either variable or fixed. So factory utilities, we could make a case for that being somewhat fixed, and we'll find out about a little bit later in a different chapter. We'll talk about mixed costs, and that's actually where utilities falls. But for this chapter, we'll call it variable cost. The factory supervisor salary. Well, it's factory, so it's product. It's not direct materials. It's not direct labor, so it's overhead. It's not a period cost because it's a product cost. It's a salary, so it's fixed. Store equipment depreciation. That's not a product. That would be a period cost. And it's probably fixed because depreciation doesn't change when we have a product or when we produce more product. Factory equipment depreciation. Well, it's a product cost. It's not direct materials. It's not direct labor. So it must be manufacturing overhead. Factory equipment depreciation, it's depreciation, so it doesn't change, so it's fixed. Advertising, monthly. So we have a monthly advertising cost. That's not a product, that's a period. Since it's a flat amount each month, it's fixed. Our model car tires. That's a product cost because we're selling model cars. And it sounds like it's direct materials. It would also be a variable cost because it goes on each product. Store property taxes. We have a store, we're not producing, it's not a production cost, so it's a period cost. It doesn't vary, so it's fixed. Factory insurance. It's a product cost because it has to do with the factory. It's not direct materials, not direct labor, so it must be overhead. We hope that it's not variable. We hope that it doesn't vary according to the number of units we produce, so we're going to call that a fixed cost. Factory worker wages. Okay, that's a product cost. They're working in the factory and they have wages, not salaries, so that's direct labor. And it's probably a variable cost, although again, I would call that a step variable, but we'll talk about that in a later chapter. Marketing manager salary, not a product cost, a period cost. It's a salary, so it's fixed. Glue and screws, product cost, not direct materials, because remember, we don't trace something that small, so we'll call it overhead, and it's going to be variable. Machine maintenance costs, again, product cost, not direct materials, not direct labor, so we're going to call that manufacturing overhead. And that would be a variable cost because the more we use the machine, the more it will have to be serviced. All right. So that's classifying costs. One more example where we add everything up just for some more practice. So we have this information for Wonderway. We have factory rent, we have company advertising, wages paid to laborers, and so on and so forth. We're asked to compute each of the costs. So we'll start with direct labor. This is E1-11. The first one, direct labor. If we go through our list, and you can read through these on your own, but I'm just going to talk you through them. The wages paid to laborers, so that would be our direct labor. Let's just go through the list first, and then we can just add stuff up. So factory rent would be manufacturing overhead. Company advertising would be a period cost. Wages paid to laborers would be direct labor. Depreciation for the president's vehicle would be a period cost. Indirect production labor would be manufacturing overhead because it's not direct labor, it's indirect labor. Utilities for the factory, manufacturing overhead. The production supervisor's salary, manufacturing overhead. The president of the company's salary, that would be a period cost. Direct materials used, direct materials, that would be direct materials. Sales commissions. Sales commissions, that's a period cost because it has to do with sales. Factory insurance, manufacturing overhead. Depreciation on factory equipment, manufacturing overhead. Okay. So what I'll do down here is I'll just do each one of these and I'll write them out for you. So direct labor, that's 82,000. Manufacturing overhead, 40,000 plus 1,800 plus 36,000, sorry, almost said 100, 36,000. Utilities for let me just make sure. 40,000 manufacturing overhead. That's the factory rent. 1,800 is indirect production labor. 36,000 is utilities for the factory. 30,000, oops, I'm getting sloppy here. 30,000 is the production supervisor's salary. 12,000 is the factory insurance, and 26,000 is the depreciation on factory equipment. And that would total 145,800 for manufacturing overhead. 3, prime cost. So prime cost, if you'll remember, is direct materials and direct labor. So our direct materials, we would have to go back to our problem and look. That's direct materials used is 34,500. And direct labor is 82,000 for a total of 116,500. 4, conversion costs. That's direct labor and manufacturing overhead. So we use the direct labor and the manufacturing overhead to convert our direct materials into a finished product. So that would be 82,000 direct labor plus 145,800 manufacturing overhead for a total of 262,300. 5. Total manufacturing costs. So total manufacturing cost is equal to direct materials plus direct labor plus manufacturing overhead. That's all of our product cost or our manufacturing cost. So that would be direct materials was 34,500. Direct labor 82,000. And manufacturing overhead 145,800 for a total of, oops, I made a mistake somewhere. So for a total of 262,300. And I wrote down the wrong total up here. Total conversion costs would be 227,800. I can hear those of you that added this up saying, it's wrong, it's wrong. I'm sorry. So 227,800 for conversion costs and 262,300 for total manufacturing costs. 6, the period costs. There are a few of those. There's the company advertising, 20,000. And there's the depreciation for the president's vehicle of 8,000. And there's the president's salary of 60,000. And there's sales commissions of 7,500. And that totals up to 95,500. So that was just an additional bit of practice on this. Hopefully it's starting to make sense. So remember the DMDL MOH. We're just going to keep doing that. Let's go back. Let's go back here. Now let's talk about relevant versus irrelevant costs. A relevant cost has the potential to influence a decision, while an irrelevant cost, of course, will not. So and this is probably a key piece here, right on number 1. If a cost is relevant, it differs between the decision alternatives. So if you're going to make a decision and you have a cost, if you make decision 1 or decision 2 and the cost does not change regardless of which decision you choose, then it's irrelevant. If it changes when you make a choice of one decision 1 or decision 2, then we call that a relevant cost. So that they differ between the alternatives. Sometimes they're called differential costs or incremental costs. Also, if a cost is relevant, it must be incurred rather than in the future rather than in the past. If it hasn't been incurred yet, then it is probably relevant. But if it was already incurred before you had to make the decisions, choose between the decisions, then we call that sunk costs, and they're irrelevant. Sunk costs are not relevant to any decision. And then there's out-of-pocket versus opportunity costs. So out-of-pocket just means that you're out of pocket for the amount of cash. It's cash. If I choose this, it's going to cost me. But there's an opportunity cost as well. For instance, I am sure all of you have an opportunity cost along with an out-of-pocket cost to take this class. You chose to take this class. you paid for this class, but it also takes your time. And you may have to give up something else that you want to do because this takes your time. That's called an opportunity cost. And opportunity costs are important in decision making. So, big picture. I'm not going to read you this whole thing. This is actually in your textbook, and it's a excuse me. It's a good overview of everything we talked about today. So you could find that in your textbook and do a screenshot of it or something and keep that on hand. All right. That's all I have for you. I will be trying to do this for every chapter. If I see a lot of questions in the discussion about a particular topic, I may do additional examples. If you want me to do additional examples, just post it in the discussion and I'll catch it and we'll do something. Thank you so much.